Today we are going to talk about market maker models. Not only that, we are going to fully simplify market maker models so that you can leave this video understanding exactly how to apply it in the three main pillars to master market maker models. Everyone overcomplicates market maker models, and so my goal right now is to make it so stupid simple. And not only that, I'm going to show you 3 examples of live trades that I took this week. And so let's go into the computer. So let's start off with the most obvious question, which is, what are market maker models? Market maker models are a form of price delivery, both bullish or bearish. They give us an insight about market structure, liquidity pools, high value areas, SMT, and more. Market maker models are the foundation of price delivery. By mastering market maker models, you can become a profitable trader. And market maker models, as I said before, have 3 different pillars of what we will need to master. Now, this is what market maker models look like. So we have the market maker buy model. So basically the X simply stands for the buy or the sell. So market maker buy model, and here we have a market maker sell model. Now, the market maker buy model and a market maker sell model simply explain that there's going to be a sell side of the curve and a buy side of the curve. And let's say that the market is bullish. You're always going to have some sort of sell side being taken because the market needs to manipulate towards a higher time frame PD array before moving in one specific direction. And that's where you see usually, and we'll see that happening throughout this week, when I show you 3 examples that I took in the live market. We have the market moving lower. And what is happening as the market is moving lower? The market is creating this idea that actually we are going to the downside. We are moving lower. You should probably short, right? This is the idea that this is what the market is trying to do. It's trying to spark interest in the sellers. And as it's doing that, it's gathering liquidity of stops. So these are all stop losses. This is all going to become internal range liquidity. And why is that? It's because eventually once we shift at a higher time frame level, all of a sudden you are able to absolutely crush all of this liquidity, and this move can happen very, very quickly, which once again, we will see in the live market. Now, also, we have the market maker sell model, which is the same exact thing of the market having to move bullish to spark the interest of the buyers. Actually, we're going higher. Oh my God, we are going higher. That is, and you know, if you understand market maker models, that we're only going towards a higher time frame PD array. And what is that? That can be an order block on the 4 hour, on the 1 hour. It can be a fair value gap. It can be a point of liquidity. Like, how many times have you seen, for example, here, this is a screenshot actually from a student of mine where we have the sweep of liquidity and then we have the market maker buy model, or right here, sweep of liquidity, market maker buy model. All of this was actually trades from my students, which I do like to point out. So there's 3 different pillars that we need to master when it comes to market maker models. So pillar number 1 is direction. And why is that? Given that market maker models are a form of price delivery, we need to understand which market maker model we are looking for. That's where direction comes in, and we will identify it on the daily time frame. Now, pillar number 2 is going to be the high time frame key level. So the smart money reversals always happen at a higher time frame key level, be that an order block, a liquidity sweep, or a fair value gap. We will identify it on the 15-minute time frame. And pillar number 3 is going to be the key target. So we have the key level that we expect a reaction from, and we have the key target. Price delivery will only go so far. The market doesn't go up or down forever. The key targets serve as either as a TP or a directional framework. We will identify it on the 1 hour time frame. Now, there's some details that I'm going to talk about right now when we go onto the charts that are very important for you to keep in mind, because if you don't know that, you will never master market maker models. So let's just quickly go back to the structural market maker model. So you can see that as the market moves lower, you have to be able to predict that this is going to become a market maker model. And that is exactly where direction comes in, because else, who doesn't tell you that this isn't a market maker sell model, right? This can be a market maker sell model. So that's where direction comes in. That's why direction is pillar number 1. Direction is always the most important thing, no matter what, for trading. Then the higher time frame key level, you notice that the market doesn't react just out of anywhere. The market needs a reason as to why it's reacting. It's a liquidity sweep, it's a fair value gap, it's an order block. There needs to be a higher time frame key level, because if there isn't the higher time frame key level paired with direction, then you don't know what you should be trading. You don't know if it's a market maker buy model or a market maker sell model. And then last but not least, it's a key target. Like, that is pretty simple. We're going to target internal range of liquidity because I want you to have a lot of success with this. Let's go on to this week. This week, we've applied the same exact thing 3 times. One of them was a winner, one of them was a break even, and the last one was a winner. Now, I want you to notice one simple thing. This all is also a market maker buy model. But let's not overcomplicate, because I'm trying to make this as simple as possible so you are able to master this as soon as you can. And so let's look at the first trade that I entered on. So on the first trade that I entered on, what was the market doing? The market was moving to the downside, right? You can see the market was moving to the downside. Now you might say, well, Kimmel, what was the higher time frame PD array? Well, if you look back, what do we have? We have the 1 hour fair value gap. And if I quickly draw a fib on the fair value gap, you can see that we hit the 50% of that level. Not only that, if we go back towards the daily chart, which is where we identified the direction, you can see that we were bullish because the day before we had a very strong push to the upside that engulfed 2.5 candles. This to me creates a very high probability of a long, and that's why I longed. The market came towards the fair value gaps and then started to move to the upside. Now, if we go down to the 1 minute, which is where I executed on this trade, what did we have? We had the manipulation, and now we had the reversal. So a lot of people would try to enter here, but what is the problem? Well, for now, you are trying to predict where this low is going to be. So since you are trying to predict where that low is going to be, I would rather always wait for the second market shift. And that's why I missed this first trade, but I eventually entered in this second one. So we have market shift number 1, and then we have market shift number 2. And that is exactly where I executed. And then the market simply moved to the upside. And what was our target? Well, we go into internal range liquidity and we find the extreme, which is going to be here. And I just put it a little bit before that. So the market moves up and it results in a full take profit. Now, I want you to see exactly how the market reacts once we hit the take profit. So once we hit the take profit, the market ends up fully reversing the move. So anyone that was trying to still hold the market to the upside, they now got caught because they don't understand that the market maker model requires a key target. And this key target usually should not be external range liquidity, because external range liquidity, even though it will be targeted, it requires more to be targeted. And that's why I love to avoid external range liquidity and I always target internal range liquidity. But now let's move on to the next day. The next day was the exact same thing, where we have the move to the downside and then we start forming bullish order flow. What is that? Well, that's me. Given that direction is bullish, I'm only looking for market maker buy models. And so we have the sweep of the low, we have the manipulation, we have the market starting to form bullish order flow, and then the market opens up. What does it do? It moves strongly to the downside. What does this create? This creates the FOMO of traders believing, oh yeah, the market is going to move down. And then eventually we have one market shift, second market shift. Unless you consider this to be a market shift, then I would have entered on the third one. And then the market started to move to the upside beautifully. You can even see that the market range, manipulation, sweep, which means higher time frame PD array, And then the market starts moving to the upside, creating a beautiful, beautiful, profitable trade. This was even a trade that I took live inside of Funded Trading Blueprint, which is the community where we've gotten over $40 million in funding, $900,000 in payouts. We live trade every single week. We have Q&As every 2 weeks. We do a daily market breakdown in the market. So instead of trying to learn from the past with myself, you would be learning in the present, which is like the best sort of learning. Obviously, it's a full-blown mentorship. So afterwards, the market goes and starts moving lower, and eventually I remove myself at a break even. Well, I manage my trade to break even, and eventually the market does end up reaching the full take profit. So if we quickly skip to that, you can see that the market maker model worked out once again. Now you might say, well, Kimmel, we've reached a lot of targets. Not true. Why? Because on the next day, what happens? Another market maker model. Look at how this is playing out perfectly. The market starts to move to the downside, forming bearish order flow, and then impulsively moves lower. What did we mention on before? We mentioned that the market is always trying to get traders interested before moving in the real direction. Now, for every buyer, there has to be a seller. That's why they try to spark up this interest of people selling in this market. And so the market starts to move lower. So we spark the interest of the shorts. And then eventually we start, what happens? We come towards the 1 hour order block, which is the high time frame PD array. Then I went down to the 5 minute. I saw that we inverted this fair value gap. And so what was my thought? My thought, I want to enter on this fair value gap. The market moved lower, confirmed. So basically notice how even on the 1 minute, this is a market maker buyer model. Move lower, move lower, move lower, move lower. Market shift, I enter, and then the market goes in our direction. What was the target? Once again, internal range liquidity. Notice how I am not trying to target the big high. I don't care if the market moves towards this big high. I know it will, but I don't want to trade towards that big high because I know that that always includes higher time frame reversals or mid time frame reversals. Sorry, just as we've seen over the last days, where if you were to not manage the trade here, you would have taken a loss. Right here, you would have taken a win. And right here, we don't know yet because this is still playing out. And so for me, I always like to target internal range liquidity. And in this case, I actually made a mistake, but I still was able to make close to $10,000 just this week, putting me one step closer to profiting over $1 million from the market. Now, you can see that all of these were the exact same thing, which were market maker buy models. And that is why, because pillar number one is direction. I understood that the market is going in one direction over the long term, and that is bullish. Then the only thing I had to do was to identify the higher time frame key level, order block, liquidity, or fair value gap. If I identify one of these on the 1 hour or 15 minute, I have myself a higher time frame key level that I want to see a reaction from. And last but not least, picking the right target was what made me and the community profitable for this week. Now, if you want to get funded this year, we've gotten over $40 million in funding, students getting funded left, right, and center. On average, students are getting funded in less than 67 days. We've had multiple people joining now over the last 2 weeks and already getting funded. And so with that being said, if you want to get funded this year, and if you want to look for a way to get access to me every single day, you get a lot of access to me, then check the second link in the description. Now, if you want to check out the best futures prop firms, the one that I use, it's going to be Funding Ticks. Code Kimmel will get you up to 50% off. See ya.